Welcome everyone to a new episode of Finance in Focus. We are the podcast team from the ESFS Student Finance Society, and we are very excited to bring you in-depth insights on the latest economic and market developments. I am Laia Marsal, and joining me today, we have our amazing team members.
Good morning, I'm Laura, and I will cover the most recent global and macroeconomic perspectives. I will also focus on how commodity prices are influenced by inflation and supply chain disruptions.
Hello, my name is Francesco and I will walk you through market performance, summarizing the key movements in global indices. I will also dive into equity research, analyzing a top-performing company, discussing its recent performance, financial results and future outlook.
And I am Tony Vidal, and I did our Insights Spotlight discussion, exploring a major financial trend in depth. I will also provide the week ahead, offering insights into upcoming economic data releases and other key events that could shape the markets.
We've got a full agenda ahead, so let's get started. So to start things off, let's welcome Laura, our go-to expert on macroeconomic events. Let's begin with the latest indicators of global economic activity.
Certainly, Laia. So first, in the United States, primarily the GDP data for the first quarter came to be 1.6% annualized, well below the 2.4% that was expected. This points to a cooling in the consumer sector and a growing inventory drag, both of which are waiting on momentum.
Well, that's quite a slowdown, especially considering how resilient the U.S. economy appeared just a few months ago. So how is China shaping up?
So China showed some encouraging signs. Manufacturing activity expanded in April, with the PMI rising to 50.4. This marks the first time in 6 months that it has entered growth territory, suggesting some underlying stabilization in the sector, certainly.
A modest but welcome shift for a key global engine. And the Eurozone?
Okay, so the Eurozone posted a 0.3% GDP increase in Q1. Germany narrowly avoided recession, but overall the region continues to struggle with weak demand and fragile industrial outputs. The recovery remains under pressure.
So across the board, growth is present but fragile and increasingly uneven. Turning to monetary policy, inflation trends remain in sharp focus.
They certainly do. In the US, the core PCE index, closely watched by the Federal Reserve, rose by 0.3% in March, bringing the annual rate to 2.8%. This reinforces expectations that rate cuts may be pushed to the second half of 2025.
Well, that's certainly likely to shape investor behavior for months to come. What's the ECB position?
So, the ECB continues to strike a cautious tone. While they have hinted at a possible rate cut in June, they've made it clear that it is contingent on continued disinflation. They are watching the data very closely.
Understandably so. The balancing act between inflation control and economic support is a tricky one. And what about Japan?
Okay, so the Bank of Japan held rates steady but signaled it might tighten policy if the yen depreciation continues. It is a subtle but important shift. Japan is slowly emerging from decades of ultra-loose monetary policy.
It's fascinating to watch the Bank of Japan navigating this transition, especially given how long it maintained its previous stance. On a very different note, there was a significant power outrage on the Iberian Peninsula this week.
Yes, this was a shock, clearly for everyone. On April 28th, a large-scale blackout disrupted power across the whole Spain, Portugal, France, and Andorra. It began at 12:33 p.m. local time, when Spain's grid frequency dropped sharply, causing an automatic shutdown of power stations. Portugal, which depends heavily on Spain for electricity, also experienced widespread of outrages.
Well, that must have caused considerable disruption.
It certainly did. Transport, communications, and businesses were all affected. The root cause is still under investigation, but an abrupt loss of generation in the southwest Spain, likely solar, is suspected. The intermediate nature of renewables and their limited system inertia compared to fossil fuels contributed to the grid's instability.
Well, it's a stark reminder of the technical challenges involved in the energy transition. Integrating clean energy sources must go hand in hand with investment in stability and storage.
Yeah, precisely. The blackout underscores the need for better grid resilience, backup systems, and cross border integration. Not a retreat from clean energy, but a smarter path forward.
Well, speaking of interdependence, there was also a notable diplomatic movement between the US and China.
Yeah, correct. A U.S. trade delegation met with Chinese officials in Beijing to discuss semiconductor export controls and border economic cooperation. While no formal agreements were reached, both sides described the talks as constructive, a modest but meaningful flaw in bilateral relations.
Well, even small steps can shift tone and expectations, especially in such a high stake relationship. And what's the latest from Latin America?
Okay, so what we could spot was that Argentina announced a new fiscal consolidation plan aimed at tackling its runaway inflation and restoring investor confidence. The IMF responded with cautious optimism but emphasized the need for deeper structural reforms to ensure lasting impact.
Well, another case of short term measures needing long term follow through. Let's finish with a look at currencies and commodities.
Yeah, so the US dollar strengthened modestly, supported by rising treasury yields and delayed Fed easing. The euro held around 1.07 while the Japanese yen weakened to 157 per dollar. That prompted verbal intervention by Japanese authorities trying to stem the slide. So in commodities, Brent crude remained near 86 per barrel, driving the OPC plus discipline and stable demand. Gold, on the other hand, eased slightly to 2,280 as equity markets adopted a more risk-on stance.
So, all in all, a week of complex but interrelated developments, from monetary policy to grid infrastructure and from diplomatic signals to market sentiment.
Yes, Laia, exactly. As well as we move forward, the major areas to watch will be central bank actions, how economies adapt to renewable energy demands, and the ongoing health of global growth.
Thank you so much, Laura, for that. Now, let's shift gears and hear from Francesco, our specialist in global market trends and equity analysis. He's here to unpack recent market developments and movements and share his key takeaways from the latest equity research. Francesco, I understand markets closed with a tone of cautious optimism, right?
That's right, Laia. Despite ongoing macroeconomic uncertainties, the overall tone across major indices was one of quiet confidence. The S&P 500 closed up to 0.25% to 5,875. Gains were modest but notable. Meanwhile, the Nasdaq Composite performed slightly better, rising about 0.4%, largely driven by resilience in the tech sector, particularly renewed enthusiasm around semiconductors.
Well, it sounds like US markets are still finding selective strength. How did things play out across the Atlantic?
Well, Europe was more mixed. The Euro Stoxx 50 slipped by 0.1%. Investors there seem caught in a tug of war between the positive momentum of fiscal expansion and lingering concerns over stagnating growth, especially in core economies like Germany.
And Spain stood out, though, didn't it?
Yes, IBX 35 posted a solid recovery, rising to 0.7% to close around 10,920. What's particularly striking is that this comes just days after Monday's major internet outage, which disrupted parts of Spain's financial sector.
Well, certainly a stronger rebound in the face of technical disruption. Impressive.
Oh, absolutely. Spanish equities showed notable resilience, and the financial and the utilities sectors led the charge, suggesting that investors are focusing more on the country's improving macro fundamentals than short-term glitches. Spain, while not immune to broader Eurozone headwinds, benefits from relatively low inflation and steady domestic demand.
And in Asia?
The Nikkei 225 in Japan ended the session up 0.3%. A few volatile days that marks a welcome stabilization. Market participants are closely watching for signs of fiscal stimulus out of China, which could serve as a catalyst for regional equities in the months ahead.
So, turning to asset management, what strategies are dominating in this environment?
We are seeing a clear two-speed approach. In the short term, it's still about capital preservation. Managers are favoring defensive equities, high-quality fixed income, and maintaining a measured allocation to gold. But looking ahead, over a 12 or 36-month horizon, there is a gradual re-entry into selective risk-taking.
But what areas are gaining attention?
European banks, especially those aligned with the US nearshoring trends, are back on radar. Industrial firms with cross-Atlantic exposure, as well as high-quality tech names generating solid cash flow, are increasingly being reintroduced to core portfolios. These are the kinds of positions that reward patience through volatility.
So let's wrap up with your equity in focus. Banca Generali, what's happening there?
A significant development, Laia. As of May 1st, Banca Generali stock is trading around at 52.10 euros. Earlier this week, Mediobanca launched a 6.3 billion all-share takeover offer, valuing the stock at 54.17 euros per share. That represents a 11.4% premium over the pre-announcement price.
A bold move by Mediobanca. What's the strategic play?
The deal will be financed entirely through shares in Assicurazioni Generali, where Mediobanca already holds a 13.1% stake. This isn't just about scale. Banca Generali is a major private banking player in Italy, with over 210 billion in assets under management and a strong footprint in regions like Lombardy, Veneto and Emilia-Romagna. It brings over 2 billion annually from wealth management alone.
So the goal is to pivot toward high-margin, advisory-driven growth?
Exactly. Mediobanca is aiming to transform itself into Italy's leading wealth manager, a smaller, domestically focused version of UBS, if you will. Nearly half of its revenue will come from capital-light, stable advisory services. That's a compelling value proposition, especially in an environment where traditional lending margins are under pressure.
But this being Italy, there are always layers to the story.
Quite so. The offer sits within a complex matrix of interests. You have Mediobanca, Assicurazioni Generali, and activist shareholders like Caltagirone and Delfin in the mix. There's also speculation that rival banks might submit counteroffers. If that happens, Mediobanca might need to revise its terms upwards.
So beyond the numbers, this is a strategic signal.
Precisely.
Big thanks, Francesco, for those insights. Next up, let's bring in Tony, who will be taking us through our Insight Spotlight segment. He will explore a major financial trend in depth and give us a look ahead at the critical economic data and events to watch in the upcoming week. But this isn't about another tariff or the latest market shock, right, Tony?
Exactly, Laia. Today we're looking at a crucial geopolitical shift, one that has a significant implications not only for Ukraine but for global businesses and financial dynamics. It's the new agreement between the US and Ukraine. We're going to break down the clauses of the contract, what this means for the future and why it's so important. So let's get started.
All right, Tony, let's jump right into it. What exactly does this agreement between the US and Ukraine entail? What are the key clauses?
Well, this deal is a big one. It centers on Ukraine's access to its rich mineral resources, things like lithium, titanium, and rare earth metals, which are essential for industries like electronics, clean energy, and even defense. The US is getting a 50% stake in future projects involving these resources. That's a huge deal, considering how crucial these materials are for the tech and energy industries. What's even more important is that those same profits from these projects are going to be reinvested into Ukraine's reconstruction. So this isn't just about businesses. This isn't about business. It's about helping Ukraine rebuild in the aftermath of the conflict.
Well, that sounds like a strategic win for the US, especially in terms of its control over vital resources. What does this agreement mean for the future then? Could it shift the global balance in any kind of way?
Absolutely, Laia. This agreement is setting for the stage for a new dynamic in Eastern Europe. For Ukraine, it's a massive opportunity to rebuild with the help of American investment. But for Europe, the other way is it's a completely different story. The US now has a direct access to these resources and will likely become the dominant player in that region. Europe, on the other hand, risks being sidelined, especially if it doesn't move quickly to secure its own interest. Europe has to react. The agreement puts the United States in a very, very powerful position, economically and geopolitically. It's a checkmate, and that could leave Europe, which has been struggling with its own energy and resource supply chains, playing a catch-up.
Wow, so while Ukraine is getting much needed investment, Europe might end up feeling a bit left out. It's clear that this deal has huge implications for both sides of the Atlantic. But what about the actual businesses that could benefit? Who stands to gain the most from this?
That's a great question, actually. The big winners, as always, are here the American and tech and energy companies. Think about industry that need these rare earth materials or metals, electronics, electric vehicles, and renewable energy. Companies like Tesla, Apple, and even major defense contractors will likely see a boost from this deal. And that's just the beginning, that's just the start. Other American firms are already lining up to get involved in the reconstruction of Ukraine's infrastructure. The US is positioning itself as not just a political ally, but as a central player in Ukraine's economic future. Meanwhile, Europe might find itself scrambling to secure its own access to these Ukraine's resources if it doesn't act fast, if it doesn't act quickly.
So essentially, the US is setting itself up for long-term dominance, while Europe, well, it might need to rethink its strategy. This definitely seems like a game changer. All right, so let's look ahead to the week, Tony. We've seen a lot of movements in the markets recently, especially with the price of gold. Jose Luis Cava mentioned that this increase might be a signal of a bigger things that are coming, maybe even pointing to the potential for a third world war. What's your take on this?
Oh, sorry. That's an interesting one. Gold is often seen as a safe haven asset during these times of uncertainty or war. When investors are nervous, they flock to gold, which is why we've seen this recent spike of gold price. Jose Luis Cava's point is intriguing, though. He's suggesting that this could be a signal of something much more significant, like rising geopolitical tensions leading to a kind of unseen preparation for a global major conflict, but not the kind with tanks and soldiers, of course. Instead, this war could be a war fought with technology, cyber defense, and rare minerals, all powered by digital currencies, as we've mentioned in other episodes of this podcast. It's not just about the price of gold, it's about what that price movement tells us about the state of the global affairs.
Well, that is a chilling thought. So the rise in gold could be a warning sign, something much bigger than just financial markets reacting to uncertainty.
Exactly, it's a signal that something fundamental is changing, whether it's the rise of new geopolitical blocs, the growing isolation of countries, or the struggle over crucial resources. The gold price is reflecting that unease. And these investors, we need to keep a close eye on how these signals unfold. It's not just about the numbers, it's about the story behind them, as usual.
So Tony, this has been one of the most thought-provoking episodes yet. You've given us a lot to think about, from the Ukraine agreement to the rise in gold, and what all it matters for the future.
It's been a pleasure, like always, Laia. But let me leave you with this. The world right now is like a chess game where everyone's trying to anticipate the next move. Some are panicking, others are waiting, but the ones who really understand the game, they already positioning themselves quietly, making their moves while everyone is still figuring out their strategy.
I love that analogy, Tony. If there's one thing that we've learned today, is that we need to stay sharp, stay curious, and always keep our eyes on the bigger picture. Thank you, Tony, for that valuable insight into the latest financial developments and what to expect in the coming week. Shifting gears to something closer to home, let's explore how the ESFS Student Finance Society is providing students with opportunities to deepen their knowledge in finance and investment. In this edition of Events Spotlight, we turn to Shark Tank ESADE 2025, an event that offered students a rare and valuable window into the world of early stage investing. 8 high potential startups presented live in front of a distinguished panel of investors, competing for up to 1.5 million in funding. Startups such as Bebel, Oso Global, and Nano each delivered focused high pressure pitches followed by real-time investor feedback. For students, the experience provided practical insights into how investment decisions are made, what defines a strong business case, and how to clarify confidence and resilience play into a founder's ability to persuade. With over 400 attendees across in-person and online formats, this year's editions marked the most attended to date, underscoring the growing relevance of entrepreneurship within the ESADE community. More than just a competition, it was a powerful learning opportunity and a reminder of the value of stepping into real-world challenges early. Also, the 4th ESADE Finance Summit is taking place on May 8th at the ESADE Pedralbes Auditorium. At this exciting event, you will get to hear from top executives like Fernando Gomez and Lara Yak, who will dive into key trends across investment banking, private equity, and wealth management. Learn about the latest macroeconomic strategies and how the industry is evolving. Plus, it's a great opportunity to network with leaders from top firms like Goldman Sachs, JP Morgan, Lazard, and Deutsche Bank. For just €5, your ticket includes food, drinks, and access to exclusive industry insight. Don't miss out. Grab your tickets now before spots run out. So, let's wrap this week's episode. This week, we brought a wave of mixed signals on the macroeconomic front. U.S. GDP growth slowed more than expected, hinting a softer consumer demand, while China showed early signs of stabilization and the Eurozone continued to struggle with weak momentum. Central banks remain cautious. Rate cuts in the U.S. may be delayed. The ECB is watching the data closely, and the Bank of Japan is slowly shifting away from its ultra-loose stance. Equity markets responded with measured optimism. The U.S. posted modest gains, while Spain stood out in Europe with a strong rebound despite recent infrastructure disruptions. Asset managers are staying defensive in this short term but beginning to re-enter selective opportunities, especially in European banks and industrials tied to nearshoring trends. In our Insight Spotlights, we explored the landmark U.S. Ukraine resource agreement, a strategic move that could reshape global supply chains and tilt economic influence further towards Washington, while leaving Europe racing to catch up. And finally, the rise in gold prices may signal more than investor caution. It could reflect deeper geopolitical shifts, from resource control to digital warfare, reminding us that markets often react before headlines do. Looking ahead, key inflation data, central banks' commentary, and geopolitical developments will be critical to watch. As always, staying ahead of this shift is key to making informed decisions. Thank you for tuning in, and we will see you next week for more insights and analysis.